Joining us now is a man that's going to challenge Chris Hart, who's my guest host, on his gold position, Mr. Henk Potts, equity strategist at Barclays Wealth. Henk, you may challenge Chris Hart now on his gold views.
Well, listen, gold has been a tremendous performer over the course of the past 5 years. But I think if you look at the reasons why people are buying gold, and maybe you'll come back to me and you'll say, listen, technically the charts are telling us to buy gold once again.
It's not technical,
but I tell you what, if it's on the fundamentals, then the argument falls apart very quickly indeed. Because tell me, if you're buying gold as a hedge against inflation, inflation expectations have been falling. If you're buying gold because you're taking advantage of the weaker US dollar, well, the dollar's been strengthening and expected to be stable. So what are you left with? Gold as a safe haven status.
Systemic instability, because I tell you what the problem is that we've managed money. I think with the capital asset pricing model, where effectively cash and bonds are your defensive safe haven sort of assets, and your bond equities, property are your sort of growth or aggressive sort of assets. What do you do in a world where bonds and cash start to become the epicenter of risk, where you've got debasement risk and you've got default risk starting to occur there?
Well, listen, you're thinking about a world that looks an awful lot worse tomorrow than it does today. Well, and we wouldn't necessarily agree with that scenario.
Well, it is deteriorating. The debt levels are still rising and the growth levels are dropping.
Yeah, okay.
That is something that's...
Well, let's get a sense from you, Henk, with regards to where you see growth going. We've got the IMF forecast, of course, downgrading growth globally.
Well,
I can see you got a grin.
Still at 4%.
Oh, global
so
growth
it's
is
not a
3%.
disaster.
US, though, 1.3?
The US is still growing. Listen, at the start of the year, we were talking growth from the United States, 3%. Clearly, that is not achievable. I think the second half of the year looks a lot better than the first half. Borrowing costs are down to historically low levels. Gas prices have been falling. The recovery that we've seen in Japan has been quicker than stronger than many analysts have been anticipating. So maybe you see 2% growth in the United States in the second half of the year. Still positive. Maybe 2.4% as you look to 2012.
So no recession that you're expecting, right? You're not expecting a recession?
No,
you're
we're not
expecting
looking at a recession, I don't think. A default is certainly possible from a Greek perspective, but that doesn't necessarily bring down the global economy, particularly if the authorities are more proactive. Clearly, they've not been as proactive as required. Finally moving down the road. I think there's three things that need to happen in terms of the Eurozone. Number one, those within indebted countries need to introduce austerity measures in a transparent and tangible way. Number two, the bailout mechanisms need the financial firepower required. We're getting towards that. We're now talking 2 trillion euros. And of course, the establishment of a European-wide bond.
So how is this then affecting your investment sentiment? Because you're far more optimistic than the people that I've actually been speaking with.
I would agree with you in certain aspects. The way that we position portfolios at the moment is, number one, we're overweight cash. So we are still concerned about that. We see that as the best safe haven. We certainly see it as the best value safe haven compared to gold, compared to government bonds. In terms of government bonds, we're underweight historically. Obviously, they're incredibly expensive at the moment. There's no doubt about that. And therefore, we agree also that the investment side, the growth side of your portfolio should be driven by exposure to equities. And we're excited about the equity position.
Especially strong dividend pays. That is my...
Because companies, picking up on your dividend thing, companies are awash with cash at the moment. Their balance sheets are very healthy outside the financial sector. Look at the number of share buyback programs that have been announced. Warren Buffett, Berkshire Hathaway say, look at the dividend increases that are coming through. Look at the pickup in business investment. So actually the corporate picture looks an awful lot brighter than the macro picture. So I think there's a real battle in investors' minds at the moment. You've got these big macro issues. Some are going to take longer to fix than others. I think the Eurozone can be fixed with political help. The US actually just needs time, so we can be relatively positive there. So they're not insurmountable, but on the other side, you've got this very bright corporate picture. Corporate profitability, incredible.
Emerging market equities or global equities or both?
Well, we prefer developed market equities. I think the US would be our favoured market. If you look at earnings momentum and valuation, US looks great at the moment. Despite the problems in terms of the Eurozone, there are some plays within core Europe. Valuations are very cheap. You say you want to see them cheaper, and listen, they may go cheaper, right? But you're buying at historically low values at the moment. I'm not sure how much you want to be enticed into this market to take advantage of these levels.
Buy Greek equities.
Buy one, get one free. I'm not sure what you're looking for.
Something like that. No, I think it's a case of that the To my mind, the debt problem is expanding and the growth is actually deteriorating, and that dynamic is not great. Can earnings momentum be maintained in a deteriorating macro
I think companies have adapted very quickly to the lower demand environment, much leaner and meaner than they were before. Even if you go into a period of rather anemic economic growth, it's very quickly filtering through to the bottom line. If you look at the global quoted corporate sector, we saw 30% profit growth last year. We're looking at 15% this year. We've already penciled in a further 10 to 15% next year. So the corporate profitability picture is incredibly bright.
Henk, what about commodities? Do you want exposure to resource companies right now?
No, listen, I think in terms of commodities, most of the good news is already priced into those. We've seen a bit of retracement coming through. Long-term fundamentals still remain very supportive. The growth that we're seeing is coming through from China. The commodity intensiveness of that growth is obviously much higher than a traditional developed market recovery. Economy continuing to grow and to recover should be good news in terms of manufacturing. And of course, you've got agricultural commodities benefiting from faster growing, richer emerging markets where you're seeing a change in diets coming through. So there are some plays in terms of industrial metals. China the key. If China continues to grow, they account for 40% of global demand for industrial metals.
Yeah.
If you believe in China, then you've got to believe that there are some opportunities.
On that very high note, we have to leave it there. It's unfortunate. Thank you so very much, gentlemen, for joining me. Much appreciated. Henk Potts from Barclays Wealth, and of course, big thank you to my co-host, Chris Hart from Investment Solutions.